Welcome to the Sykes & Company PA video blog featuring Ollin Sykes.
Ollin, in the past, many pharmacies were bought from seller financing, and I understand that in the last few years there's now a new way for people to think about buying a pharmacy entity. Tell us a little bit about that.
Yes, Rachel. The changing of the guard in the independent community pharmacy industry has definitely changed in the last 6 to 7 years. Prior to a couple of players in the marketplace, most of the financing that took place was either seller financing or it was done through local or regional banks, and that can be problematic itself, as there are a number of issues involved in and around that create issues with that add complexity to financing transactions even today. And perhaps we can talk a little bit more about that in a few minutes. But the most common way that we see transitions taking place today is really through the model that there are two primary players out in the marketplace. The largest is Live Oak Bank. They lend to pharmacies all over the country through a special SBA process. There's a second player that's named First Financial that's in the Arkansas, Mississippi area that also has a nationwide reach. And both of those institutions have specialized pharmacy divisions that deal with pharmacies daily and make loans in transitions to new buyers. And you might find it unusual that in a typical $4 million transaction, $4 million retail pharmacy revenue wise, those opportunities are such that a pharmacist in their 30s that has experience and a reasonably good credit rating, that would be something over a 700 FICO score, may only have to put in $25,000 as a down payment in this transaction, maybe to borrow $1.5 million to $2 million for that transaction. And that seems like almost an impossible situation to imagine, but it is true. And the reason that it can be done is that in a typical transaction, the banks will typically come in, provide long-term term monies, will typically add a certain amount of working capital to the loan. The bulk of the loan, of course, goes to the seller. Whether assets are being bought or whether the common stock is being bought is a whole nother discussion. But in either scenario, the seller, in most cases, will be required to take back a portion of his selling price in what's called a subordinated note. And that subordinated note will be typically a 2-year term where interest accrues but is not paid. And that seller subordinates his interest to the bank and SBA in that process. And that seller's subordinated note is viewed as equity by the SBA. And you might say, well, no, I don't want to get involved with the SBA. I've heard it's a nightmare. Well, it is. But these lenders that I'm speaking about here are preferred lenders with the SBA. Everything they do can be done internally. Typically, I've seen these transactions occur in as quick as 6 weeks. And they don't have to be long, drawn-out processes unless the bank that you're dealing with doesn't do this each day. If your bank doesn't do it each day, yeah, it can draw it 6 months. And I've seen that happen, involved in some situations right now where some regional banks thought they could handle something of this nature, and it's not working as quickly as they thought because they're not a preferred lender with the SBA. So really the moral to the story is if you're interested in buying a pharmacy, if you find a pharmacy that has good profitability, and even though you may not have any funds, or very limited amount of money to put down payment, but you want to be a pharmacy owner, there's a multiplicity of ways now to purchase a pharmacy and to get it financed without undue hardships on you as the buyer. And quite frankly, buying a pharmacy, an existing pharmacy, versus starting up an organically grown pharmacy, you're going to be, in most cases, far better off in purchasing that existing pharmacy, because chances are in a 5 to 7 year period of time, you'll probably have paid down that note dramatically and may have already gone into a second or third pharmacy, as I most often see. And if you're starting up a pharmacy, it's going to take you $500,000 in cash and or debt financing right up front. Good luck at getting that put together. And then you still got the risk that in a year and a half to 2 years, you're not profitable. So, again, the moral to the story is go to those that lend for pharmacies on a full-time basis, use their expertise, engage yourself with accountants and attorneys who do nothing but this, i.e. the healthcare pharmacy arrangement and field. And there's tremendous resources available through the NCPA, especially with the NCPA Ownership Workshop. These are excellent 2.5-day presentations where tremendous amounts of information and the kinds of things I'm talking about now are shared in detail at those conferences. So try to attend one if you're looking at purchasing a store potentially.
What's the difference between seller financing and using a bank with a specialty in lending to pharmacies?
Well, seller financing can be easy if the seller is well off and he doesn't need the funds and he's willing to take a long-term note and provide you a reasonable rate of interest. But if he puts, let's say, a 3 or 5 year call on that note, that can be problematic for you because just the point in time you really start to turn the pharmacy into a real profitable arrangement, you got to go through the whole process again. Mm-hmm. And the two opportunities that I'm talking about with the two pharmacy lenders that are giant in this industry, they're typically 10 to 25 year terms and notes with no call provisions and typically no covenants. And you try to find a community bank in your area that's going to give you money without covenants. Good luck.
Thank you for joining us today. If you want more information or have any questions, please feel free to contact Ollin directly.